Welcome to The Explainer. If you've been looking for a stock market guide for beginners, or maybe you just want to know how to invest without the massive headaches, you are exactly where you need to be. Today, we're tackling a huge debate: day trading versus long-term investing. Think of this as your ultimate guide to stop losing money and finally understand how the markets actually work. Let's be real for a second. We all want to grow our wealth, right? But the second you open a finance app or read an article, you're just hit with this wall of confusing jargon. Bulls, bears, candlesticks, dividends. It's literally enough to make your head spin. If you're a complete beginner feeling totally overwhelmed, take a deep breath. Today, we are going to completely demystify the financial world and break down the exact differences between the two main paths to making money in the markets. So here's our game plan for today. We'll start with trading versus investing explained, then look at the core differences, walk through some real-world examples, weigh the pros and cons, figure out which path fits you, and finish up with an essential educational disclaimer. All right, let's jump straight into Section 1, Trading versus Investing, the basics explained. First up, trading. Simply put, trading is all about buying and selling financial assets, like stocks, currencies, or crypto, over really short periods of time. A trader's entire goal is to profit from price fluctuations. We're talking about capitalizing on short-term market volatility. These trades can last anywhere from a couple of weeks down to literal milliseconds if we're talking about computer algorithms. Honestly, it's all about timing the market's immediate mood swings. Now, on the flip side, we've got long-term investing. This involves buying assets with the strict intention of holding onto them for several years or even decades. You're not trying to time quick price jumps here. Instead, you're betting on the actual value and economic growth of a company over the long run. Basically, you're becoming a partial owner of a business, and you're just waiting for it to expand over time. Moving on to Section 2, Core Differences, Comparing Strategies. First, let's look at the time horizon. As you can see here, there is a massive difference. Over on the short end, trading lives in the realm of minutes, hours, and days. It is incredibly fast-paced. But as we move across the timeline over to investing, we're measuring time in big chunks, 5, 10, or even 20-plus years. Think of it like this: traders watch the clock, while investors watch the calendar. Next up is their main objective. A trader's objective is to profit from volatility. They want to buy low and sell high, and they want to do it quickly. They actually thrive when prices are bouncing all over the place. An investor, however, is looking for steady capital growth and dividend payouts. They want the underlying asset to become intrinsically more valuable over the long haul. So how do they actually make their decisions? Well, trading relies heavily on technical analysis. This means staring at charts, hunting for price patterns, and analyzing trading volume to predict short-term moves. Long-term investing, on the other hand, relies on fundamental analysis. Investors are looking at a company's financial health, its industry sector, and the broader economic outlook. So in short, traders study human behavior on a chart, and investors study actual business health. Finally, let's talk about the required effort and, frankly, the stress level. Trading requires active, daily monitoring and incredibly strict emotional management. You're probably going to need a lot of coffee for this one. You need tight risk management, like stop losses, just to prevent fast, unpredictable drops from wiping out your account. Investing is way more passive. It smooths out those temporary market downturns, which means you really only need to do periodic portfolio reviews, maybe quarterly or annually. So a lot less screen time and a lot less daily stress. Okay, let's make this concrete in Section 3, Real-World Examples in Practice. Picture a day trader. The market opens at 9 a.m. and boom, they immediately buy a stock because a technical chart pattern suggests there's going to be a quick morning rally. By 2 p.m. that exact same afternoon, they sell it. Whether they made a small profit or took a small loss, they are totally out of the trade before the closing bell. It's rapid, it's calculated, and the whole thing is done within hours. Now contrast that sharply with the long-term investor. Our investor researches a fundamentally solid company, buys the shares, and then just holds on to them for 15 solid years. Through recessions, dot-com bubbles, random market panics, they just hold. They let compound interest and reinvested dividends do all the heavy lifting, confidently betting on the company's long-term expansion. Let's break down the trade-offs in Section 4, Pros and Cons, Weighing Your Options. Let's walk through this balance. For trading, the big pros are the potential for really quick gains and the flexibility of having multiple opportunities every single day. But the cons? Well, there's a very real risk of fast, significant losses. It demands high technical skill, intense psychological discipline, and you're going to get hit with frequent transaction fees. Honestly, this is exactly why the failure rate for active day traders is notoriously high. On the other hand, long term investing offers far less daily stress and harnesses the historically proven power of compound interest, riding the reliable upward trend of broad markets like the S&P 500. The downside there? Your capital is tied up for a really long period, and the returns require supreme patience because they aren't always visible in the short term.
Section 5. Which path fits you? Choosing your strategy.
The right choice depends entirely on your available daily time, your personal risk tolerance, your ultimate financial goals, and your current level of market knowledge. Look, if you work a demanding 9 to 5 job, day trading might just be impossible. But if you love fast-paced analysis, investing might completely bore you. Here's a little secret, though. A lot of smart individuals actually combine both. They keep the vast majority of their money in a stable, long-term investing portfolio while setting aside a much smaller, speculative amount to use as an active trading fund. So I've got to ask you, which profile fits you best? Are you a fast-paced trader or a patient investor? Drop a comment below right now and let me know. And hey, if this explainer is clearing things up for you, make sure to hit that subscribe button for more clear, jargon-free financial education. Let's wrap things up with Section 6, Essential Educational Disclaimer, Important Note. Please remember that this explainer is provided for educational purposes only and does not constitute personalized financial advice. Whether you choose to go with trading or long-term investing, both carry the very real risk of capital loss. The market is absolutely not a guaranteed ATM. The golden rule here is to start only with amounts you can truly afford to lose. Consult a licensed financial advisor if you need personalized help, and whatever you do, never stop learning. Your absolute best asset is always your financial education. The market will always be there tomorrow, but the real question is, a decade from now, will you be the one exhausted from staring at daily charts or the one patiently collecting dividends? Keep exploring, keep learning, and I'll see you in the next explainer.